A central corporate headquarters tracks every transaction occurring within its own walls. But out in the field, at an isolated storefront, physical distance creates an immediate administrative challenge. This remote location operates as what is known as a dependent branch. The defining constraint of a dependent branch is that it does not perform its own local bookkeeping. It receives inventory, makes sales, and handles customers, but all the financial transactions are recorded on ledgers sitting miles away on the desks of the head office. This setup creates an obvious tension. If the local staff isn't keeping the books, the head office must figure out how to accurately determine if that specific, isolated location is generating profit or quietly bleeding money. To bridge this information gap, central management selects from 3 distinct accounting frameworks. The choice isn't random. It is dictated entirely by the size of the branch and the exact degree of oversight headquarters demands. The system they deploy establishes the working relationship between headquarters and the branch. The bookkeeping method determines how much autonomy the branch receives and how deeply headquarters can peer into its daily operations. The first and most straightforward framework is the debtor system. Headquarters typically applies this to relatively small branches that operate primarily as simple sales depots. The mechanics are highly consolidated. Instead of tracking multiple categories of branch activity, the head office opens a single, unified branch account. Every mutual transaction between headquarters and the remote location is recorded here. Within this single account, headquarters maintains a degree of pricing flexibility. The goods shipped out to the branch can be invoiced at the raw cost price, or they can be marked up and invoiced at the final selling price. Because everything flows into one place, this system functions similarly to a consignment account, the standard method used when shipping goods to a third-party agent. To extract the profit, you simply look at the end of the ledger. The balancing figure at the bottom inherently equals the net profit or loss for the entire period. It is mathematically elegant. But a highly aggregated system like this creates an operational blind spot. By condensing all branch activity into a single number, headquarters loses the ability to spot specific inefficiencies or pinpoint exactly where margins are eroding. As a branch grows and handles more volume, headquarters requires a much clearer picture of its overall financial health. They deploy the final account system to separate what the location owns from what it earns. The structural shift begins by restricting the original unified branch account. It no longer calculates profit. Instead, it serves purely as a personal account to track the net assets currently sitting with the branch, what is due to or from that location. To calculate operational profit, headquarters introduces a new tracking mechanism, the Memorandum Branch Trading and Profit and Loss Account. Unlike the debtor's method, this ledger requires profit is calculated based strictly on the raw cost of goods sent, rather than an inflated invoice price. Splitting the data into 2 distinct buckets cures the blind spot. Headquarters can now independently verify the value of the assets tied up in the branch, while gaining clear, unobstructed visibility into its actual operational performance. The final evolution is the stock and debtor system. Headquarters implements this method when they demand total control over remote inventory and mandate strict selling prices that the branch cannot alter. The single or dual account models are entirely abandoned. To gain control, headquarters deploys a web of granular control accounts, isolating specific categories of data into individual ledgers for branch stock, branch debtors, and branch expenses. Calculating profit requires 2 steps. First, the branch adjustment account determines gross profit by extracting loading, the difference between raw cost and invoice price. Then, this transfers to the branch profit and loss account, where specific expenses are subtracted to reveal net profit. By fragmenting the data into tightly controlled, separate accounts, central management eliminates the information deficit. They achieve surgical, item-level oversight over a storefront they may never physically visit. The accounting strategies progress from a single, aggregated ledger to a bifurcated model separating assets from operations, and finally to a granular web of interconnected control accounts. A headquarters does not graduate to a more complex system simply because a branch acquires more floor space. They upgrade because they have a diminishing tolerance for operational uncertainty. Selecting an accounting framework is a strategic act. It is the mechanism by which central management reaches across physical distance to enforce corporate policy, control pricing, and monitor local expenses. For a dependent branch, the ledgers kept back at headquarters are the invisible architectural framework. They ensure that no matter how remote the location, profitability is closely engineered, strictly tracked, and heavily